Imagine waking up tomorrow, opening your investment app, and seeing your portfolio down 30% in a single day. That massive destruction of wealth actually happens. During the 2008 financial crisis, the global stock market lost trillions of dollars in value in a matter of months. Today, financial analysts are watching specific warning signs. Interest rates are rising rapidly, and broad economic uncertainty is making the markets nervous. Over the last few years, the valuations of major tech giants have ballooned. Companies like Apple have grown dramatically since the introduction of the first iPhone. This massive growth extends across modern sector leaders, with companies like Tesla seeing massive price increases. When markets rise this fast across the board, a sudden drop feels catastrophic. When those fast-rising markets inevitably drop, human instinct triggers an immediate panic response. But acting on that fear is usually the single biggest financial mistake an investor makes. Most of the time, markets go through a correction, a routine drop of 10 to 20% before recovering. But a true market crash is different. It is a rapid, severe, and uncommon plunge in financial value, going far beyond a routine dip. Understanding the mechanical difference between a routine speed bump and a deep financial cliff is the crucial first step to overriding your biological urge to panic. Major systemic shocks happen occasionally. Look at the burst of the dot-com bubble in early 2000, when tech stocks rapidly lost value. Then came the 2008 financial crisis, another massive shock that rippled through the global economy. And more recently, the COVID-19 pandemic triggered a terrifying rapid plunge across global markets. But despite these terrifying drops, a consistent historical pattern emerged. Each time, the market eventually recovered and reached new, higher peaks. When markets start falling, amateur investors often let fear take over. They panic sell their investments at the exact moment prices hit rock bottom. Historically, the crashes themselves rarely destroy long-term wealth. It is the investor's own biological panic response that locks in their financial losses. Experienced investors actually do the opposite. They stay calm and view market uncertainty as a rare opportunity to buy assets at discount prices. Their first strategy is diversification. Instead of putting all their money into one company, they spread their financial risk across completely different industries. Their second strategy is committing to the long term. They hold on to their investments and ride out the valley until the market recovers. Their third strategy is actively buying during the dip. They target strong companies with reliable fundamentals, meaning businesses with consistent revenue, manageable debt, and solid cash flow that suddenly become available at lower prices. This often means acquiring shares in modern tech behemoths like Alphabet, whose stock might be temporarily undervalued because the broader market is panicking. While amateurs react to the market's emotion, professionals rely on cold mathematics and solid company data to acquire valuable assets cheaply. This macroeconomic chart shows the global economy spanning several decades. It reveals a continuous upward trend, proving markets operate in endless cycles of booms, corrections, and recoveries. Fear pushes prices down short-term, but innovation and economic expansion eventually push them back up. Because these are human systems, no one possesses a crystal ball to predict exactly when the next major drop will arrive. Financial survival requires untraining your emotional reactions. You have to prioritize patience, thorough research, and long-term thinking over short-term panic. Market crashes are predictable features of the economic system. Over time, they reward disciplined investors and punish those who panic. If you want to understand these market cycles and learn more investing strategies, make sure to subscribe to the channel. Understanding the market today will help you make logical, fear-free decisions tomorrow.